So hello everyone, and I want to pick up on chapter 3. I'm sorry, chapter 2, with regard to where we left off, and we kind of left off with this nice little video here about broker markets and buying and selling shares, right? So here's the definition of a broker market, and it says most broker markets consist of national or regional security exchanges, and a security exchange. Let's look at that. Is an organization that provides the marketplace in which firms can raise funds through the sale of new securities and purchasers can resell securities. So it's like, so for instance, the New York Stock Exchange, right, which is referenced right here, and in short, NYSE. So that's the dominant broker market, okay? So that's the big one. And for the most part, they've gone more and more electronic. So in case of any kind of terrorism or storms or anything. So, and they're pretty spread out. So here's the details. For a company to list its securities for trading on the exchange, it must file an application for listing and meeting a number of requirements. For example, to be eligible for listing on the New York Stock Exchange, a firm must have aggregate pre-tax earnings of at least $10 million. So they give you all the details here. What it would take to list on the New York Stock Exchange, okay? Which is, again, a broker market. Okay, so now a dealer market is, there's no centralized trading floor. If you go to Midtown Manhattan, you'll see a place called NASDAQ, a big building called NASDAQ. And it's all electronic trading through computers. There's no trading floor. So there's market makers linked together via a big telecommunications network. All right, so the way this works is, let's click on NASDAQ Market. It's an all-electronic platform used to execute security trades. And anybody know what NASDAQ stands for? National Association of Security Dealers Automated Quotations. And you use it to execute security trades. And it's got another name. It's called in general, the over-the-counter market. Market where smaller unlisted securities are traded. Right? So, so a lot of times these are lumped together. And these make up about 25% of all shares in the United States. So they make a little aside here. As an aside, the primary market is also a dealer market because all new issues are sold to the investing public by securities dealers, acting on behalf of the investment bank. So here it is, the National Association of Security Dealers Automated Quotation System was founded in 1971, and again, it's called NASDAQ. So you can clearly see it was part of the OTC market, but today it's a totally separate entity, and it's not really part of the OTC market, but traditionally they still lump it together. Okay, so going away from the domestic area, we have the international capital markets, okay? And one of the areas is called the Eurobond Market. And this is a market in which corporations and governments typically issue bonds denominated in dollars and sell them to investors outside the United States. So they're bonds denominated in American currency, but they're sold in other countries, okay? So that's important to know. So just as a point of fact here, and these are really good, according to the Money Project, in 2016, the world boasted 60 major stock exchanges with a combined total market value of $69 trillion. The largest stock market in the world, as measured by the total market value of securities listed on that market, is the NYSE, with listed securities worth more than $18.5 trillion, or about 27% of the total market value for all major exchanges globally. So the NASDAQ is quite large, and the NYSE is quite large, and NASDAQ is got about 7.5 trillion. Okay, so what's the role of capital markets? So capital markets, being stocks or bonds, disseminate information and allow you to trade, but they do it in an efficient way such that theoretically everyone has the same amount of information. So it's a market that establishes correct prices based on information that technically everyone should have for the securities that firms sell and allocate funds to their most productive uses. Okay, so there's a theory, it's called the efficient market hypothesis here, and this describes the behavior of a market in which securities are in equilibrium, which means they're at their price that they should be based on information they have, and they fully reflect all available information and react swiftly to new information. And because stocks are fully and fairly priced, investors need not waste time looking for mispriced securities. So all the information is there. And so here's the items we were just looking at. So that's an important concept. And this already leads to insider trading. And, you know, it goes on and it'll always go on. So, and you can read some of the stories here about insider trading incidents. So, you know, information comes in and it goes out, and it's very unpredictable. So, you know, you can read all this and all right, so the markets have to be regulated to have fair, efficient markets, right? You have to regulate them. And there's a lot of regulatory bodies. I mean, we talked about the Glass-Steagall Act, which has been repealed since then. And the Glass-Steagall Act established the Federal Deposit Insurance Company. It provides insurance for deposits at banks, so your money is always going to be insured, right? And then there was 1999, the Gramm-Leach-Bliley Act. So this was an act that business combinations between commercial banks, investment banks, and insurance companies. So you can see they allowed all these combinations and permitted institutions to compete in markets that prior regulations prohibited from entering. Okay, so then when we had the big recession in 2008, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in July 2010. Okay. But that's a very complicated act, and there's a lot of rules, and it's hard to, abide by. But here's the historical. Now we get to the historical acts. The Securities Exchange Act, and there's a lot of good history here in this chapter. The Securities Exchange Act of 1934, and then the creation of the Securities and Exchange Commission. So this is the primary government agency responsible for enforcing federal securities law. But I believe you should have a table in your book that, or maybe it's in another book. All right, so here's the process of issuing stock. So the initial rounds of external financing for business startups it goes with an investment bank, and companies want to go public and they go issue shares to an investment bank, and the investment bank will sell the shares to the public. All right, so before this happens, a lot of companies have private equity, and private equity are called angel investors or venture capital who loan money to a promising company, okay, and they get money back in return. They get a large cut if there's any profits, the angel investors or venture capitalists have done their research, and they know fair well that the company will probably do good. And as it does good, they get their their money. You can see they provided over $50 billion to like companies such as Facebook and Amazon. All these companies had angel investors to start, all the internet companies. So there's a nice table here of venture capital investors, different types, right? So there's a lot of different, and you could Google a lot of these places, a lot of venture capital places. So they invest in either early stage, late stage, or buyouts. So they basically set up a legal agreement with the company here. And you can see venture capitalists will require more equity ownership and pay less for it if the riskier and less developed the business. So they look at the risk in a particular business. So that's part of their that's part of their job. All right. So eventually, if the company is doing well, it will go. So when the company decides to go public, they want to sell their stocks in the primary market, and they do an initial public offering with the help of investment banks. And they issue a rights offering in which the firm sells new shares to existing stockholders, right? Or they'll do a public offering in which they'll sell new shares to the general public. So they have a lot of options how they want to go public, And they have to get approval from the current shareholders who are the private shareholders. Okay. And like I said, the investment bank will help them sell their shares. And then they issue what's called a prospectus, which is a portion of the security registration statement. And it describes the aspects of the company and how they're going to go public. Okay. And here's a typical prospectus. This is called a red herring because it's got this red stripe. It's a preliminary prospectus. So you can see Snap is going to issue 200 million shares. And so eventually, as I said, the investment bank kicks in. And the investment bank basically takes over and begins issuing the shares to the public. And there'll be one major investment bank, and then there'll be other smaller ones, sometimes called an underwriting syndicate. Okay, so here's how the selling process goes. Here's the corporation, and here's the investment banks, right? Basically. And here we are. And there's a good discussion here on how the investment banks are compensated. Here is the final prospectus. You notice there's no red line up here, right? Without the red. You notice that? So here's the final proceeds for the company, right? Depending on the price of the shares when they've sold in the IPO and how many shares were sold. So that gives you the final price. So, you get what's called the market capitalization, which is the current market price of the stock times the number of shares outstanding. So that's that, and there's a nice little video here which I guess we'll watch.
Underpricing is a significant portion of total costs incurred by firms when they sell new securities, and this is particularly true for the initial offering or IPO of a firm's common stock. The term underpricing is used because generally the offer price, the price at which the firm sells the new shares in the primary market, is less than the market price, the price investors in the secondary market are willing to pay for the shares. This means that the firm has left money on the table, i.e., additional proceeds it could have realized by selling the shares for a higher offer price. By underpricing their shares and leaving some money on the table for the primary market investors, IPO firms create incentives for all necessary parties to participate in the IPO process. This example calculates the IPO underpricing for Camping World, which went public on October 7, 2016. From Camping World's IPO prospectus, which can be found online at sec.gov through EDGAR, we can find that the IPO offer price was $22 per share. Using Yahoo Finance, we can confirm that on the first day of secondary market trading, Camping World stock closed at a price of $22.50 per share. To find the IPO underpricing, simply divide the difference between the secondary market closing price of $22.50 and the IPO offer price of $22 by the IPO offer price. Doing this calculation, we find that the underpricing is equal to 0.0227 or 2.27%. This level of IPO underpricing for Camping World is extremely low relative to the 17.9% average IPO underpricing in the United States between 1990 and 2016. This relatively low IPO underpricing might reflect a relatively minimal level of uncertainty among the various IPO participants regarding the value of Camping World common stock. In terms of money left on the table, Camping World's total proceeds were $250.8 million, and the market value of its offering was $256.5 million, so the difference of $5.7 million was the money left on the table. This, however, is a far cry better than had Camping World experienced the average IPO underpricing of 17.9%. Which, given their $22.50 market price, would imply an offer price of $18.47 and money left on the table of $45.9 million.